Chapter 2: Risk Assessment and Internal Control. Audit risk and its components. Inherent risk. Inherent risk is a susceptibility of assertions about account balance, class of transactions, disclosures toward misstatements. These are risks that arise from entity objectives, nature of operations, and industry, regulatory environment, and its size and complexity. Control risk. Control risk is risk that there may be chances of material misstatement even if there is control applied by management. It is the risk that entity's internal control will not prevent, detect, and correct material misstatement on a timely basis. Some controls risk will always exist because there are inherent limitations of any internal control system. Risk of material misstatement. It is anticipated risk that material misstatement may exist in financial statement start of audit. In financial before start of audit. It has two components: inherent risk and control risk. Risk of material misstatement is equal to inherent risk multiplied by control risk, detection risk. It is a risk that material misstatement remained undetected even if all audit procedures applied. Audit risk. It is a risk that auditor will issue inappropriate opinion while financial statements are materially misstated. It has two components: risk of material misstatement and detection risk. Audit risk is equal to risk of material misstatement into detection risk. ROMAM is inversely related with detection risk. Audit materiality is inversely related with audit risk. Steps for risk identification. Steps for risk identifications. Risk significance of assessed risk and impact of its occurrence. Determine likelihood of occurrence of assessed risk. Document assertions that are affected. Consider impact of risk on each assertions. Identify degree of significant risk that requires separate attention by auditor. Inquire and document management's response. Risk-based audit approach. Meaning of risk-based audit approach. Risk-based audit is an approach to audit that analyze audit risk, sets materiality thresholds based on analysis and develops audit programs that allocate larger resources to high risk areas. In risk based audit, auditor does not need to perform audit procedures on all areas of audit. General steps and phases in conduct of risk based audit. Risk assessment. Risk assessment phases involves following steps: planning or overall engagements, performing procedures to understand business and identify inherent and control risk, assessing risk of material misstatement in financial statement, identifying significant risk that require special consideration, communicating any material weakness in control to TCWJ. Risk response. Performing audit procedure that respond to assessed risk and reduce risk of material misstatement to low level. Reporting. Issuing appropriate audit report based on audit findings. Internal control system. Meaning of internal control system. It means all policies and procedures, internal controls adopted by management for efficient conduct of business, safeguarding of assets, prevention and detection of fraud or error, accuracy and completeness of accounting records, and timely preparation of reliable financial information. Objective of internal control system. Objectives of internal control. Transactions are executed through management authorization. All transactions are recorded in appropriate manner. Assets and records are safeguarded from unauthorized access or use. Assets are verified regularly and action is taken regarding discrepancies. Basic accounting control objectives. Whether all transactions are recorded, real, properly valued, recorded timely, properly posted, properly classified and disclosed, properly summarized. Inherent limitation of internal control system. Management consideration that Cost of internal control does not exceed expected benefits. Potential human error due to clear carelessness, distraction, and judgment mistakes. Possibility of circumvention of internal control through collusion with employees, etc. Possibility that persons responsible for exercising control could abuse that responsibility. Manipulations by management with respect to judgments required in preparation of financial statements. Components of internal controls. There are five components of internal control framework: control the environment, risk assessment, control activities, information and communication, monitoring. Control environment. Control environment encompasses following elements: communication and enforcement of integrity and ethical values, commitment to competence, participation by TCWG, organizational structure, assignment of authority and responsibility, human resources, policies and practices. Risk can arise or change due to following risk assessment. Risk can arise or change due to following circumstances: changes in operational environment, new personnel, new or revamped information systems, a rapid growth of operations, new technology, new business models, products or activities, corporate restructuring, expanded foreign operations, new accounting pronouncements. Control activities. Control activities may be categorized as policies and procedures related to following: performance reviews. It includes reviews and analysis of actual performance versus budgets, forecasts, and forecasts and prior forecasts and prior performance, physical controls, segregation of duties, information and communication. Information system consists of information infrastructure, physical and hardware components, software, people, procedure, and data. Monitoring. Monitoring of control includes considering whether they are operating as intended. Internal check systems and internal audit. Internal check system. It implies organizational of overall system of bookkeeping and arrangement of staff duties such that no one person can carry through a transaction and record every aspect thereof. Objective of internal control system: to detect error and fraud with ease, minimize possibility of commission of errors and fraud any staff, to increase efficiency of staff, locate locate responsibility area where actual fraud and errors occurs, to protect integrity of business, to prevent misappropriation of cash and falsification of accounts. Consideration on which effectiveness of internal control system depends: clarity of responsibility, division of work, standardization, appraisal. General consideration General conditions pertaining to internal check system. No single person should have complete control over important aspects of business operation. Staff duties should be rotated with from time to time. Every member of staff should be encouraged to go on leave at least once a year. Persons having physical custody of assets must not be permitted to access books. There should be exist an accounting control in respect of each class of assets. Mechanical devices should be used to prevent loss or misappropriation of cash. Budgetary control should be exercised and wide deviations should be reconciled. For inventory taking at close of year, trading activities should be suspended if possible. Financial administrative powers should be distributed judicially among officers. Procedures should be laid down for periodical verification of accounting records. Internal audit involves continuous and critical appraisal of functioning of entity with a view to suggest improvements and add value to strengthen overall governance mechanism of entity, including its internal control system. Internal audit also involves evaluation of internal control to provide assurance to management regarding design, implementation, and operating effectiveness of control. Scope of internal audit is determined by management. Assessment and evaluation of internal control. Well-defined set of standard of operating procedures. It assess in assessment in and evaluation of control. Enterprise risk management, segregation of job responsibility, job rotation in sensitive areas, delegation of financial powers, documents, IT-based control. Enterprise risk management, a robust process to identify and mitigate risk across enterprises. Segregation of job responsibilities, multiple activities should not be concentrated on one individual. Job rotation in sensitive areas, job rotation is regularly followed to avoid control degeneration. Delegation of financial powers, document, clearly defined document on delegation of powers. IT based controls, embedded controls through system instead of human dependent. Techniques of evaluation of internal control, questionnaire, checklist, flowchart. Questionnaire, it is a set of questions framed in organized manner about each functional area. It is intended to be filled by entity executives who are in charge of various areas. Basic assumptions that about elements of good control in standardized internal control questionnaire. Organization permits extensive division of duties and responsibilities. Employees of accounting functions are not designed any custodial function. No single person has responsibility of completing transactions by all by himself. There would be evidence to identify person who has done the work. Work performed by each one is expected to come under review of another. There is proper documentation and recording of transactions. Checklist, it is a series of instructions or questions on internal control which the auditor must follow or answer. A checklist is a reminder to the auditor about matters to be checked for testing internal control system. Flowchart, it is a graphic presentation of internal control in organization and is normally drawn up to show controls in each department. It provides most comprehensive way for reviewing internal controls. It gives a bird eye view of system. A properly drawn up flowchart can provide a neat visual picture of whole activities of department. More specifically, it can show at that point a document is received, number of copies in which a document is received, distribution of document to various department, checking authorization and matching, filing of documents and final disposal. International Internal Control Framework. Internal control integrated framework issued by committees of the sponsoring organization of the Tradeways Commission. COSO framework. Guidance on assessing control published by the Candidate Institute of Chartered Accountants. COCO. Control objectives for information and related technology. Internal control guidance for directors on the combined code published by Institute of Chartered Accountants in England and Wales. Turbulence report, Turnbull report, Sarbanes Oxley, section 404. खाइए कोसो फ्रेमवर्क. अच्छा, it was introduced in 1992 as guidance on how to establish better controls so companies can achieve their objectives. Five components of COSO framework. control environment, risk assessment, control activities, information and communication monitoring. Framework list Framework lists three categories of objectives: operating objectives, reporting objectives, compliance objectives. Operating objectives related to effectiveness and efficiency of entities operation. Reporting objectives related to financial and non-financial reporting stakeholders. Compliance objectives related to entities compliance with applicable laws and regulations. COCO framework. This framework was developed by Canadian Institute of Chartered Accountants. It includes 20 criteria for effective control in four areas of organization: purpose, commitment, capability, and monitoring and learning. COBIT framework. It is a framework created by ISACA, Information System Audit and Control Association for IT Governance and Management. COBIT has 34 high level process that cover 210 control objectives categorized in four domains: planning and organization, acquisition and implementation, delivery and support, and monitoring and evaluations. Chapter 2 ended.